Welcome, curious minds, to another deep dive. Many people jump into the world of trading, drawn by that shimmering promise of unlimited profits, the allure of freedom, and maybe even a dash of heroic status.
The dream.
But here's the stark reality. Very few actually achieve consistent success. We often assume it's about having, a superior intellect or finding that mythical perfect system. But what if the real secret lies closer to home, like inside your own mind?
Indeed. It's a journey that often starts with this intense external focus, right? Analyzing charts, news, only to eventually turn inward. And you realize the true challenge isn't the market itself, but our internal response to it.
And that's exactly our mission today. We're taking a deep dive into the profound insights of Mark Douglas, a true pioneer in trading psychology, and his transformative work, Trading in the Zone.
A classic, really foundational stuff.
Our goal is to unpack why consistent winners think so fundamentally differently. We want to identify the common psychological pitfalls that trap most traders in, well, a cycle of frustration.
Yeah, that boom and bust cycle.
Exactly.
Hmm.
And ultimately, to discover the essential mental framework needed to truly thrive in the unpredictable, ever-shifting world of the markets.
And we're drawing directly from excerpts of Douglas's foundational book. It's a work that doesn't just challenge conventional wisdom. It really flips it on its head.
How so?
Well, it delves deep into the often overlooked mental aspects of trading, suggesting that the source of your consistency isn't where you might expect it to be. Not in the analysis, but in the mindset.
Okay. So yeah, get ready to rethink everything you thought you knew about market success.
Mm-hmm.
Okay, let's unpack this. Our journey begins with what Mark Douglas identifies as an unexpected but crucial shift in how we approach trading.
Mm-hmm.
From the analytical to the deeply mental. It's a fascinating evolution, especially when you consider the history.
What's truly fascinating here is how Douglas traces the historical evolution of trading analysis. When he first started observing the markets back in 1978, fundamental analysis was truly king.
Right, looking at all the company data, economic reports.
Exactly. This approach involved meticulously considering every conceivable variable that could impact a company or commodity, from interest rates and balance sheets all the way down to weather patterns and geopolitical events.
Wow, everything.
Everything. The entire aim was to project future prices by understanding all these underlying economic and physical forces. The belief was, if you could just master enough data, you could predict exactly where the market should go.
So it was all about building these elaborate mathematical models.
Yeah.
Almost like an attempt at perfect foresight, right?
Right.
Trying to predict the weather by understanding every single molecule in the atmosphere. It sounds so logical on the surface, doesn't it?
It does. If you just have enough information, you must be able to predict the outcome.
Yeah.
Precisely. But Douglas points out a critical, often ignored flaw. These fundamental models rarely, if ever, factored in other traders as variables.
The human element.
The human element. Prices don't move just because of objective economic facts. They move because of individuals expressing their beliefs, their hopes, their fears, their expectations about the future.
Makes sense.
He vividly recounts how many traders, particularly those on the chaotic floors of futures exchanges who could dramatically move prices with their large orders, often didn't even consider fundamental supply and demand.
Really? So what were they basing trades on?
Their actions were frequently prompted by emotional factors, by crowd psychology, by intuition, all forces completely outside the parameters of any fundamental model. This led to a very frustrating reality for those clinging to fundamentals. Inconsistent profits, despite seemingly sound logical analysis.
So even if your perfectly rational model said the price should go up, if enough people were acting emotionally or irrationally or simply on different information, it might not. That sounds like a recipe for constant frustration and shattered expectations.
It absolutely was. A recipe for tearing your hair out, probably. This inherent inconsistency in fundamental analysis, this gap between objective reality and market price, it paved the way for the rise of technical analysis.
Okay, so looking at charts, patterns.
Exactly. Once dismissed as mystical hocus pocus by Wall Street and major institutions, technical analysis became widely adopted. Why? Because it showed more consistent results by identifying recurring patterns in collective behavior.
So less about the why, more about the how.
Precisely. It was less about why the market moved and more about how it moved, recognizing that human behavior, even if irrational on an individual level, could form predictable patterns when aggregated. It offered a way to observe behavior and profit from its tendencies.
This shift feels quite intuitive. If fundamentals are about the machine of the market, technicals are about reading the footprints left by all the people interacting with that machine. You're analyzing the effects rather than trying to divine the causes.
Well put.
Yeah. But then, Douglas says something truly profound. Despite the efficacy of technical analysis, many traders are still dissatisfied. They experience this huge gap between understanding the market, seeing the patterns, identifying setups, and actually turning that knowledge into consistent profits. What exactly is that gap?
This is where the focus inevitably shifted. If market analysis, whether fundamental or technical, wasn't fully solving the problem of consistent profitability, then the core issue must lie elsewhere.
Right. Somewhere deeper.
And that's why the focus moved from analyzing the market to analyzing oneself, what Douglas calls mental analysis. It's about understanding and mastering the internal landscape of the trader, because that's where the real inconsistency originates. It's in your head.
And this brings us right to what he calls the psychological gap. I think anyone who has ever, dabbled in trading or really any high-stakes performance-based activity can relate to this common frustration.
Oh, yeah.
You've probably looked at a price chart, predicted a move correctly, maybe even saw it unfold perfectly, but then you did absolutely nothing, zero. And you just anguish over all that money you could have made.
Or worse, you did get in, but fear made you exit way too soon, leaving huge profits on the table. That feeling. Ugh.
Or the flip side, letting a winning trade turn into a loser because you were hesitant to take profits. Or you just hoped it would come back.
Been there. This gap between intellectually knowing what to do and actually doing it effectively and consistently under pressure, that's the core frustration for most traders. Douglas emphasizes that it's this internal conflict that makes trading one of the most difficult and certainly one of the most mysterious endeavors to truly master. It's almost as if you're battling yourself more than the market.
But then, after painting that rather, bleak picture of common experience, he hits us with an unequivocal yes to the big question. Is mastery possible? He says it's absolutely possible to trade with the same ease and simplicity as just watching the market. That's a bold claim, isn't it? Especially for those of us who have felt the constant emotional roller coaster of fear, hope, regret.
It is bold, but he offers a vivid analogy to drive this point home, contrasting the handful of consistent winners with everyone else. He likens them to the Earth and the Moon.
Okay, Earth and Moon.
Both exist in the same solar system, right? Both are celestial bodies, but they are as different in nature and characteristics as night and day. While consistent success feels seemingly within reach for the majority, constantly available just like the moon is visible in the sky, it consistently slips away or evaporates before their eyes time and time again.
Wow.
The vast chasm between wishing and achieving is psychological, not intellectual. It's about the internal environment.
That's powerful. The moon is always there, seemingly close, but the journey to get there is incredibly difficult, and only a select few make it. And for the overwhelming majority of traders, the only thing that is consistent is emotional pain.
Yeah.
Fear, anger, frustration, disappointment, betrayal, regret.
Interspersed with only fleeting moments of elation after a lucky win, usually.
It sounds like a deeply painful experience for most.
This brings us to a crucial point where Douglas debunks traditional explanations for success. He emphatically states it's not intelligence, hard work, better analysis, or even superior system.
Really? Not even hard work?
Not primarily, no. In fact, he highlights that consistent losers often include society's brightest and most accomplished individuals: doctors, lawyers, engineers, scientists, CEOs, wealthy retirees, entrepreneurs, people who are successful everywhere else.
That's counterintuitive.
And even, and this is a surprising fact, the industry's best market analysts are the worst traders imaginable.
Get out. Seriously.
Seriously. They can tell you exactly what should happen, why it should happen, build the perfect case, but they can't actually do it themselves consistently in the market. They can't pull the trigger or manage the trade properly.
That's a real eye-opener. My initial thought would be, surely more knowledge has to help. We tend to think that if you just study hard enough, understand the markets deeply enough, then success is guaranteed. But Douglas says that's simply not the case.
Nope.
So if it's not any of those things, what is the defining factor? What separates the Earth from the moon, in his analogy?
The defining factor, according to Douglas, is that the best traders think differently. It's not what they think about necessarily, but how they think. They've attained a specific mindset, a unique set of attitudes, beliefs, and perspectives.
An operating system almost.
Yeah, exactly. An operating system that allows them to remain disciplined, focused, and above all, confident despite adverse market conditions. This mindset makes them no longer susceptible to the common fears, misperceptions, and self-sabotaging errors that plague everyone else. It's an internal transformation.
So it's not about being fearless by nature, but about developing an attitude that removes fear's power, essentially. Here's where it gets really interesting. He also points out that most successful traders endured significant pain, both emotional and financial, before acquiring this necessary attitude.
Yeah, the school of hard knocks.
The rare exceptions are those who were lucky enough to have proper guidance from the very beginning of their careers. It seems like a trial by fire for most.
It really does, and this raises an important question. Why this painful path? Douglas says it's because trading is chock full of paradoxes and contradictions in thinking.
Paradoxes, like what?
Well, many principles that make perfect sense and work quite well in daily life, guiding us to success and safety, have the opposite effect in the trading environment.
Oh, okay. Give me an example.
Like in life, avoiding mistakes is often key to success, right? Double check your work, plan carefully. But in trading, trying not to be wrong, that fear of making a mistake, it paralyzes you. You hesitate, miss opportunities, or hold losers too long.
I see. Or in life, controlling outcomes is often possible. You work harder, you influence things.
Exactly. But in trading, the illusion of control, believing you can dictate what the market does, leads to ruin. You fight the market, double down on losers. This fundamental misunderstanding, this inability to adapt our everyday thinking to the unique realities of the market, leads to what he terms financial and emotional disaster.
That's a perfect segue into our next big idea, the illusion of risk-taking and the uncomfortable reality of true responsibility in trading. Douglas argues that most people who trade think they're risk takers simply by, putting on a trade, just clicking buy.
Seems obvious, right?
Yeah. But he says this couldn't be further from the truth. How can you be trading and not be a risk taker? It sounds paradoxical again.
It's precisely the paradox. He makes a crucial distinction between taking risk and accepting risk. While trading is inherently risky, no outcome is guaranteed, and the possibility of being wrong or losing money is always present, the mere act of putting on a trade doesn't automatically mean you've accepted that risk deep down.
Okay, so what does accepting risk look like then?
Accepting risk, in Douglas's view, means embracing the consequences. Being wrong, losing money, missing out on an opportunity, or leaving money on the table without emotional discomfort or fear. It means letting the market do what it will and you remaining neutral to the outcome, ready to act objectively based on your plan.
Ah, so it's not about the action of opening a trade, but about the emotional state surrounding that action and its potential outcome.
Yeah.
The pros, then, they can put on a trade without hesitation and just as freely admit it's not working and exit even with a loss without experiencing that debilitating emotional discomfort. The inherent risks don't cause them to lose their discipline, focus, or confidence. They're like surgeons, maybe, making precise movements without emotional attachment to the outcome of that specific incision.
Exactly. That's a great analogy. For the majority, this is the core problem. If you can't trade without emotional discomfort, without fear, then you haven't truly accepted risk. Trying to avoid the unavoidable, which is risk in trading, leads to disastrous effects.
Because you start making decisions based on avoiding pain, not on your strategy.
Precisely. Our natural ingrained tendency to avoid pain, whether it's the pain of being wrong or the pain of losing money, makes trading exceptionally difficult. It's that natural self-preservation instinct optimized for a predictable, physical world working directly against us in this unique, probabilistic environment. It's like trying to avoid the rain by running indoors, but in trading, the rain is an inherent part of the weather. You can't avoid it, you just need an umbrella. Or maybe just accept you'll get wet sometimes.
And Douglas identifies 4 primary trading fears that lead to all sorts of self-sabotaging behavior.
The fear of being wrong.
Big one. Ego involved.
The fear of losing money.
Obvious, but powerful.
The fear of missing out, FOMO.
Drives chasing behavior.
And the fear of leaving money on the table, cutting winners too soon. I'm pretty sure every listener has felt the sharp sting of at least one of those, probably all 4 at some point. Oh, absolutely. These fears, he explains, have profound impacts that directly undermine success. Fear distorts perception, making us unable to see opportunities clearly or process information objectively. You literally don't see what's there if you're afraid.
Like wearing blurry goggles.
Exactly. It immobilizes us both physically and mentally, causing hesitation or freezing when decisive action is required. It narrows our focus, blocking out awareness of other possibilities or critical information that doesn't align with our fearful bias. You only realize what you knew or should have done after the event is over, when the fear has subsided and clarity returns.
That hindsight is 2020 thing.
Mm-hmm. And Douglas is absolutely clear the source of these problems is internal, stemming from inappropriate beliefs and attitudes, even though it feels like the market is actively causing the pain or conspiring against you.
So it's not the market doing something to you, but your internal framework reacting to the market in a way that causes pain. This really challenges the common perception that the market is, this cruel, unpredictable beast out to get you.
Right. It's neutral.
It makes perfect sense then why Douglas says that the belief that more or better analysis is the solution is just a trap, a black hole of analysis. My gut tells me to analyze more when things go wrong, but he's saying that's counterproductive.
It's a profound trap. Because most traders mistakenly believe that if they just gather more information, if they analyze the market better, if they find that next secret indicator, that will be the solution to all their trading difficulties.
The Holy Grail search.
Exactly. This leads to an endless, futile quest for more market variables, more complex models. But, as Douglas emphasizes, the market is limitless. It can do anything at any moment. There's no fixed structure to definitively predict it.
No matter how smart you are.
No matter how much you learn, you'll never learn enough to anticipate every possible way that the market can make you wrong or cause you to lose money. If you're fundamentally afraid of being wrong or losing, you'll never have enough confidence in the face of constant, inherent uncertainty. The information becomes overwhelming, not empowering. It just feeds the fear.
And this is where confidence and fear become contradictory states of mind. Confidence in trading requires absolute trust in yourself. Trust that you will act appropriately, follow your plan, regardless of the market's unpredictable movements.
Trust in your process.
And this self-trust doesn't come from endless market analysis, but from training your mind to override those natural counterproductive inclinations, like the deep-seated need to be right or to avoid pain at all costs.
It leads to a clear, stark choice. Either try to eliminate risk by endless analysis, which is, as he puts it, the path of ultimate frustration and that black hole you can never escape.
Keep digging deeper.
Or radically redefine trading to truly accept risk and eliminate fear. As long as you're susceptible to these fear-based errors, rationalizing a losing trade, hesitating on a winning one, jumping the gun out of impatience, or just hoping the market saves you, you simply cannot trust yourself to execute your plan.
Your own mind betrays you.
Exactly. And consistent results become next to impossible. The internal conflict will always override your best intentions.
So if there are no external rules in the market, no boss, no strict guidelines, no safe boundaries, who makes the rules for the trader? This leads us to the uncomfortable truth of responsibility.
Yeah, this is a big one.
Douglas says trading offers unlimited freedom of creative expression, unlike almost any other endeavor in life. Few restrictions, seemingly boundless opportunities. Sounds great, right? What's the downside to all that freedom?
This very freedom, ironically, presents unique and specialized psychological challenges because there are no external rules or boundaries to guide or structure our behavior. The market is like a constantly moving stream without beginnings, middles, or endings. You can jump in or out anytime.
Unlike, say, a poker game with clear rounds and forced bets.
Exactly. Unlike gambling games, which force risk definition with their structured payouts and formal endings, trading allows you to become a passive loser. You can simply do nothing in a losing trade, letting the market take everything you have. You literally can just sit there and watch your capital vanish. There's no game clock to save you.
That's a terrifying thought, just paralysis as it drains away.
Yeah.
And the paradox is, the very freedom that attracts us makes us feel a natural resistance to creating the kinds of rules and boundaries needed for success.
Right. We want freedom, but we resist the structure that enables success within that freedom.
We chafe at putting limitations on ourselves in this seemingly unlimited environment. And Douglas says he usually takes a great deal of pain and suffering to break this deeply ingrained resistance and finally embrace self-discipline.
And this resistance often manifests as blaming the market. Novice traders, when they lose, often lash out with phrases like, "the market did this to me," or "it wasn't fair." Douglas links this to childhood experiences of powerlessness and betrayal when things were taken away.
Like a toy being snatched.
Yeah. It's a natural, human, but ultimately counterproductive reaction. He highlights that the market is a zero-sum game, fundamentally. For every gain, there's a corresponding loss somewhere else. One trader benefits only if another loses. If you blame the market, you haven't accepted this fundamental reality and are projecting your hopes and expectations onto an indifferent entity. The market doesn't care about fair.
So it's not about the market owing you anything or being inherently fair or unfair. Taking responsibility means believing your outcomes are based squarely on your interpretations of market information, your decisions, and your actions. Period.
It's a very different perspective. It puts the locus of control entirely on the trader, which can be daunting, but also empowering eventually.
How is it empowering? Seems scary.
Because if you're responsible, then you have the power to change the outcomes by changing your approach, your mindset, your actions. If the market is responsible, you're just a victim.
Okay, I see that. And not taking this responsibility creates two major psychological obstacles, he says.
Right. First, it fosters an adversarial relationship with the market. You start setting up a fight between you and the flow of opportunity. You perceive the market as against you if you expect it to do something for you, rather than simply presenting neutral information and opportunities.
Like thinking the rain is personally trying to ruin your picnic.
Exactly. Second, it misleads you into believing that market analysis alone can fix your problems, sending you spiraling down that black hole of analysis again, endlessly seeking external solutions to an internal problem. The market is neutral. It doesn't know your desires or your trading account balance. Fighting the market is effectively fighting yourself, your own interpretations and reactions.
This sounds like the root of revenge trading then, that impulse to jump back in after a loss, not with a clear head, but with anger.
Absolutely. After that initial painful loss, the great feeling of winning motivates learning about the market, but not necessarily to win systematically. It's often for revenge, to conquer the market, to prevent the market from hurting him again, to prove it wrong. And Douglas says this leads directly to self-sabotage, sealing one's fate as a consistent loser. You make emotional, irrational decisions driven by anger, not strategy.
It does. And if you have to be right, if your self-esteem is tied to being correct about market direction, you will define any opposing market information as intensely painful.
Because it feels like a personal attack.
Right. And your mind will then engage powerful pain avoidance mechanisms, rationalizing it'll come back, distorting reality, that signal doesn't count, blocking information that contradicts your view.
Confirmation bias on steroids.
Exactly. This creates a vicious cycle where learning more and expecting more certainty from that knowledge only compounds the pain when the market inevitably doesn't conform to your predictions. It's a fundamental conflict between our deep-seated human desire for certainty and the market's inherent, inescapable uncertainty.
You dig yourself deeper.
So if all of this is true, how do the consistent winners actually navigate this complex psychological landscape? This brings us to the core of Douglas's work. The mindset of a consistent winner, which is all about embracing probabilities.
Right. This is where things start to shift towards the solution. Douglas identifies 3 categories of traders, almost like distinct species in the trading ecosystem.
Okay, what are they?
The smallest group, fewer than 10%, are the consistent winners. They have steadily rising equity curves, like a well-tended garden, maybe with small dips, but generally upward. They seem unaffected by euphoria or self-sabotage. Their success is a reflection of their internal consistency.
The elite few.
Then there are the consistent losers, about 30–40% of traders. Their equity curves are mirror images of the winners steadily downwards, characterized by many small losses and occasional, usually accidental wins that give false hope. They often have profound illusions about trading or are simply addicted to the action, the emotional highs and lows.
The largest group.
Yeah.
The middle ground.
The largest group, maybe 40–50%, are the boom and busters. They learn to make money, sometimes quite a lot, but they just can't seem to keep it. Their equity curves look like roller coasters. A nice, steady ascent, building confidence,
Feeling good.
followed by a steep, painful drop-off, often wiping out weeks or months of gains, repeating over and over again.
This is probably the most relatable category for many listeners, I imagine. That feeling of 2 steps forward, 3 steps back.
Absolutely.
Yeah.
The danger for this largest group lies specifically in euphoria. When you're winning, you're least likely to concern yourself with potential problems or risks. Euphoria creates supreme confidence, makes risk virtually inconceivable in your mind. You feel invincible.
Like you've cracked the code.
Exactly. This leads to overtrading, violating established rules, taking larger positions than planned, maybe even believing you are the market and can do no wrong. But the market rarely agrees with such hubris, and when it inevitably disagrees, the result is usually a huge loss, often triggering a mind freeze of disbelief and paralysis.
Deer in headlights.
And the boom-bust cycle repeats. The euphoria sets you up for the fall.
And self-sabotage is another hidden enemy you mentioned, not just euphoria.
Right. Douglas talks about how losses can also stem from subconscious conflicts about deserving to win. Maybe from deep-seated beliefs instilled by religious upbringing, or a strong work ethic that equates struggle with greediness, or even unresolved childhood trauma related to receiving things easily.
So you subconsciously torpedo yourself when things go too well.
It can manifest that way. Lapses in focus, inexplicable errors like putting in a sell order instead of a buy, or simply getting distracted by something trivial and missing perfect opportunities. It's like an internal governor preventing sustained success.
Wow, that's deep.
What's truly fascinating here is Douglas's assertion that the market doesn't create your attitude or state of mind. It simply acts as a mirror reflecting what's inside back to you.
The market as a mirror.
Yeah. If you are confident and disciplined, it's because your beliefs are aligned with the market's probabilistic nature. If you're angry and afraid, it's because you believe the market controls your outcomes and owes you something. Not taking responsibility keeps you stuck in that painful cycle of blame and dissatisfaction.
And he stresses that the pain of leaving money on the table, that feeling of seeing a huge winner that you're in but then exited too early or failed to enter at all, is often more painful than an actual loss.
It really is, bizarrely, because you can't blame the market. It was your inability to act appropriately. The pain is purely self-inflicted. There's no external scapegoat.
Ouch. So the cornerstone of a winning attitude, the first and most critical step towards consistency, is taking complete, unwavering responsibility for all outcomes. Good, bad, ugly. It's all on you.
That's the foundation. This is the first step to changing your experience from fearful and frustrating to confident and calm. Consistency, then, is truly a state of mind.
An internal state reflected externally.
It's an entirely internal solution. Douglas states unequivocally, the solutions are in your mind and not in the market. Consistency is a byproduct of specific beliefs and attitudes about the market and about yourself.
And he says your best trades feel easy, right? Effortless.
Exactly. Your best trades, he points out, are easy, effortless, almost in the flow. There's no struggle, no second guessing. Trying to trade, on the other hand, that feeling of effort and strain indicates deep internal struggle and resistance.
Interesting distinction.
The best traders don't try to get anything from the market. They make themselves available to what it's offering without forcing an outcome. They're receptive, not aggressive.
This reminds me of his analogy about the child and the snake. You mentioned that.
Right. A child isn't inherently afraid of snakes unless taught to be or has a bad experience. Similarly, top traders aren't fearless due to some inherent courage or nerves of steel. They simply don't perceive anything the market does as threatening.
Because they've accepted the risk.
They've accepted the risk, and they operate from a belief system where market movements are just information, not threats. If there's no threat perceived, there's no fear generated. And therefore, no need for courage or brute force self-control. It's an absence of internal conflict.
That's a crucial insight. So it's not about willpower, it's about perception.
Most traders start carefree, perhaps get lucky with a few wins, then get scared by subsequent losses, and their potential diminishes as fear takes over. The ones who break through learn to embrace responsibility and risk, often after significant emotional and financial pain. They literally transform their mental environment, their operating system for dealing with uncertainty.
And this transformation leads to what Douglas calls debugging your mental software, like finding the bugs in your thinking.
Exactly. The goal is to fundamentally redefine your relationship with market information, removing the inherent threat of pain by changing your mental framework. He explains that our perception is not passive. Our internal energy, our knowledge, our beliefs, our fears acts like a filter, limiting and blocking much of the available information.
So what you believe determines what you see.
In a very real sense, yes. What we know and believe makes opportunities visible. What we haven't learned or are afraid to acknowledge remains invisible or is misinterpreted.
You give an example of that?
He gives a clear one. A perfectly valid trading signal after recent losses feels overly risky. Why? Because your mind automatically links the now moment signal to the past pain of losing and projects that pain onto the present opportunity.
So you hesitate or skip it.
Right. Now, the same exact signal after recent wins feels riskless or like a sure thing. Why? Because of euphoria. You project the recent positive outcomes onto the present. The market signal itself is neutral. You are the one who charges the information with positive or negative emotional energy based on your internal state and recent experiences.
Wow. So to be consistent, you must consciously control this association process. You have to somehow break that link.
You have to overcome the mind's natural default tendency to associate the present with the past, which is what inevitably leads to fear-based errors or euphoria-driven mistakes. And this leads us to the absolute secret, the core of trading success, according to Douglas, the uncertainty principle.
Okay, the uncertainty principle, what is it?
At the very core of one's ability to trade without fear or overconfidence, to perceive the market objectively, to stay completely in the now moment opportunity flow, and to spontaneously enter the zone is an unshakable belief in an uncertain outcome with an edge in your favor.
An uncertain outcome with an edge. Both parts are key.
Both are critical. The best traders have deeply ingrained the belief that anything can happen. They don't just give lip service to it. Their belief in uncertainty is so powerful that it prevents their minds from automatically associating the now moment with past outcomes, allowing them to remain truly objective.
So believing anything can happen is actually freeing, not scary.
It's incredibly freeing. This belief directly prevents rigid expectations, which are so often the source of emotional pain. It allows traders to make themselves available to opportunities, no matter how the market chooses to present them, without being thrown off if it doesn't match a prediction.
He gives that powerful example, doesn't he, about the analyst?
Yes, the experienced analyst who predicted exact market support and resistance levels based on thorough, rational analysis sounded totally convincing. But then, in an instant, some semi-retired chairman decided to sell 2 million beans on the floor, dropping the market 10 cents a bushel, completely negating the analyst's certain prediction. Poof! Gone.
Just one person's action wiped it out.
That anecdote powerfully illustrates that anything can happen due to the unseen, unexpected actions of a single trader or 1,000 of them, or some news event. The market is full of constant, unknown variables. Traders on the sidelines waiting to jump in, people changing their minds, unexpected institutional orders, breaking news. Pros factor these unknowns into their approach. They expect the unexpected.
Whereas typical traders
Often ignore them, clinging to the illusion of certainty based on what they can see, believing that what he can't see, hear, or feel must not exist. This false belief leads directly to not predefining risk, to not cutting losses, and to not taking profits systematically because they believe their analysis guarantees a specific outcome.
And this I know syndrome is a major culprit here. The typical trader believes he knows what will happen next,
This trade has to work.
which makes adhering to risk principles like using a stop loss seem completely unnecessary, even counterproductive. Douglas says this belief is the root of almost every trading error. But believing anything can happen acts as an expansive force on perception, compelling the mind to naturally think in probabilities. It frees you from the need for certainty.
And thinking in probabilities is the mental operating system of a consistent winner. They operate like casinos.
How so? Like a casino.
Well, casinos, except they don't know what's going to happen next on any single spin of the roulette wheel or hand of blackjack. Their focus isn't on predicting the next outcome.
What is their focus then?
Their focus is on having an edge odds mathematically in their favor, a small statistical advantage, and executing flawlessly over a series of events thousands and thousands of times. They know that over a large enough sample size, they will be net winners because of that edge.
So they don't sweat the individual losses?
Not at all. They understand that each individual trade, like each spin of the wheel, is merely one event in a long sequence. Its outcome is random within the probabilities, but it contributes to a predictable overall result if they stick to the plan.
And the uniqueness of each moment is also critical to this probabilistic mindset.
Absolutely. While patterns may repeat, like a head and shoulders formation might look similar to one last week, every now moment is fundamentally unique. Why? Because the participants are constantly changing, their beliefs are changing, the available information is changing, the collective sentiment is shifting. Our minds naturally try to make the present identical to the past, that's how we learn, but true consistency demands acknowledging that uniqueness and adapting to the now moment objectively.
And this highlights the gap Douglas mentioned earlier, right? Between understanding probability and actually functioning from a probabilistic perspective.
Exactly. You can intellectually grasp probability concepts. He gives the example of Bob, a highly successful commodity trading advisor, a CTA, who managed $50 million and clearly understood probabilities on an intellectual level.
So he knew the theory.
He knew it cold, but he still didn't always function from that perspective when under pressure. He let ego or the need to be right override it sometimes. In Douglas's example, Bride exited a trade out of spite, purely because it moved against him slightly, only to see it immediately reverse and go 500 points in his original direction. A huge winner missed because of emotion, not logic.
Ouch. Spite is not a trading strategy.
Definitely not. And this happens because, as Douglas says, the degree to which you need to know what will happen next is the degree to which you will fail. Pros, because they accept uncertainty, because they don't need to know, take every single trade that conforms to their edge. They increase their sample size relentlessly, allowing their edge to play out consistently over time.
It's an irony, isn't it? Unsuccessful traders crave certainty through more and more analysis.
They desperately want to know.
But true certainty, the certainty of consistent positive results over time, comes from accepting that certainty doesn't exist in the market on a trade-by-trade basis. That acceptance is what ends the frustration and liberates the trader.
It's a total paradigm shift.
And this is why predefining risk is so crucial and why most traders avoid it, because putting in that stop-loss order would directly contradict their internal conviction that they are right about the trade. It introduces doubt, which they're trying desperately to avoid.
Exactly. For a probability thinker, a wrong trade feels no different than calling a coin toss wrong. Maybe a flicker of, but no deep emotional pain because they accept the random outcome of that single event as part of the game.
And this is tied directly to managing expectations. Unrealistic expectations, those that are specific or rigid about what the market must do right now, cause immense emotional pain when unfulfilled.
Because reality doesn't match your blueprint.
And then the pain avoidance mechanisms. Rationalizing, denying, blocking information kick in, causing perceptual blindness, like ignoring a strong trend that's clearly going against your current position because you're expecting it to reverse any second.
You see what you want to see or what you need to see to avoid pain.
So, the trader's paradox. Douglas says the core strategy for success is to have rigid rules and flexible expectations.
Say that again? Rigid rules.
Rigid rules build self-trust and discipline in an unlimited, uncertain environment. Flexible expectations allow objective perception of the market, allowing you to adapt to whatever happens without emotional distress.
And the typical trader does the exact opposite, right?
Exactly. The typical trader has rigid expectations, the market must go here, and flexible rules, bending their system constantly out of fear or greed, overriding stops, taking unplanned trades. That sounds like a recipe for disaster.
It absolutely is. And this leads us beautifully to the 5 fundamental truths that form the bedrock of a winning mindset. These aren't just concepts to understand, they are functional beliefs that must be deeply internalized, lived by.
Okay, let's hear them. The 5 truths.
1. Anything can happen. This is the ultimate neutralizer of emotional threat. It aligns your expectations with reality because there are always unknown forces at play. It only takes one trader anywhere in the world to negate what you think is a sure thing. This belief keeps you humble and prepared for anything.
Okay, anything can happen. Number 2.
2, you don't need to know what is going to happen next in order to make money. Trading is a numbers game, a sequence of probabilities playing out over time. This frees you from the emotional burden of predicting the future and removes the emotional significance from individual trades. Your focus shifts from predicting to executing your edge.
Makes sense. Focus on execution, not prediction. Number 3.
3, there is a random distribution between wins and losses for any given set of variables that define an edge. This is crucial for overcoming the fear of the next trade. It means every loss brings you statistically closer to a win and every win closer to a loss within that random sequence. There's no such thing as being due for a win or cursed by a losing streak. It's just random distribution within your edge's parameters.
So let go of streaks, just focus on the edge. Got it. Number 4.
4, an edge is nothing more than an indication of a higher probability of one thing happening over another. That's it. It's not a guarantee. This focuses you on verifiable criteria, the specific things that define your edge, not external evidence, hope, or gut feelings. It takes the guesswork out and puts the emphasis on consistent execution of a known statistical advantage.
Keep it objective. Define the edge clearly. And number 5.
5, every moment in the market is unique. Even if a pattern looks familiar, the underlying conditions, the participants, the context, it's always slightly different. This belief circumvents the mind's natural tendency to link the present to the past, allowing for objective perception of what is happening now, rather than what should be happening based on prior similar-looking experiences. Stay in the now.
Wow. Those 5 truths.
Yeah.
They really cover the core mindset, don't they?
They really do. And Douglas argues if you truly deeply believe these five truths, not just intellectually but functionally, your expectations will always be in harmony with market conditions.
How so? Always in harmony.
Because you expect anything to happen. You expect a random distribution. You expect uniqueness. This means you'll always be right in terms of your expectations, effectively neutralizing emotional pain, because you expect uncertainty and randomness as part of the process. Losses are simply the cost of doing business, a necessary statistical input for your edge to play out over the long run.
It sounds almost too simple to be so profound, but the implementation, that's where the real work is, I imagine.
Exactly. Understanding is one thing, living it is another. And that leads us directly to the practical steps Douglas outlines, the mechanical stage for mindset transformation.
Oh, a practical application. How do we build this mindset?
He describes three stages of trader development. The first, and the one we need to focus on for this transformation, is the mechanical stage. This is where you build self-trust, practice flawless execution of a trading system, train your mind to think in probabilities, and create an unshakable belief in your ability to be consistent. This is the foundational stage Douglas emphasizes for fundamental psychological change. It's about building habits and installing those core beliefs through action.
And the other stages, briefly.
After mastering the mechanical stage, there's the subjective stage, where you begin to use your learned market knowledge and intuition with greater freedom, but always with constant monitoring for those old self-sabotage or euphoria issues. And finally, the intuitive stage, the most advanced level, marked by spontaneous sensing of market moves, almost like a sixth sense, going beyond rational understanding. But he stresses you can't will yourself into intuition. It's a byproduct of having fully mastered the prior stages, especially the mechanical discipline.
So focus on the mechanical stage first. What's its purpose?
The purpose of the mechanical stage is singular: to build the psychological skills, trust, confidence, probabilistic thinking, and discipline that inevitably lead to consistent results. This means achieving that steadily rising equity curve with only minor normal drawdowns, free from those wild boom-bust cycles.
And how's it achieved?
It's achieved by systematically eliminating fear, euphoria, and self-valuation-based errors through structured practice. These skills are psychological in nature and, in their purest form, are simply beliefs that you embody through consistent, disciplined action. You act your way into a new way of thinking.
So the ultimate goal here is to create a dominant belief, like installing new software, like I'm a consistently successful trader.
Exactly. And that core belief will then naturally manage your perceptions, interpretations, expectations, and actions to reinforce itself. This often involves overcoming existing conflicting beliefs, like his example of the boy who feared dogs but desperately desired to play with them. His desire eventually became stronger than his fear through conscious effort. It requires, as Douglas puts it, willingness to change, the clarity of your intent, and the strength of your desire.
Okay, so where do we start? What's the first step in this mechanical stage?
To start this transformation, Douglas says the first step is surprisingly simple: self-observation. Just begin noticing your thoughts, words, and actions while trading. Everything you think, say, or do reinforces some belief, either helpful or unhelpful.
Become aware of the internal dialogue.
Precisely. The idea is to become an objective observer of your own internal processes, without judgment. He highlights that avoiding acknowledging mistakes, often due to past judgment and pain associated with being wrong, is a major block to growth. You can't fix what you refuse to see or admit. Be honest with yourself, but not critical in a destructive way.
He uses this really powerful analogy, doesn't he? About the bridge and position size.
Yes, the Grand Canyon Bridge analogy. A trader's position size determines the width of the bridge over a mile-deep canyon. A 1,000 contract T-bond trader, for example, risking, say, $31,500 per single tick. That's a huge amount on the line for the smallest market move. They're literally walking on a thin wire.
No room for error.
None. The slightest distracting thought, a moment of fear, anger, doubt, or overconfidence is a misstep that can lead to disastrous immediate losses, far more consequential than messing up something in everyday life. So even momentary lapses in focus, caused by those internal conflicts we talked about, can have devastating account-killing effects when leverage is involved.
So the stakes magnify the need for internal consistency.
Absolutely. And he emphasizes that mistakes themselves are natural, a part of learning anything complex. But self-criticism and self-ridicule are not inherent or helpful. We aren't born to chastise ourselves mercilessly for making errors. Mistakes occur when our beliefs conflict with our desires or with market realities. Recognizing this without judgment is critical for growth and allowing new, more effective beliefs to take root. You have to remove the emotional charge from being wrong.
Okay, so observe without judgment. That sets the stage for the core practical application. The treating exercise. How does this exercise work?
Right. This exercise is specifically designed to functionally integrate the 5 fundamental truths into your mental system. It's not about finding the perfect trading system, it's about mental training and achieving psychological self-mastery through structure.
Got it. Mental workout, not system development. What's the setup?
First, the setup. You pick an actively traded, liquid market, a stock or futures contract with good volume. Then, crucially, you choose a precise edge. Any trading system, whether it's mathematical, mechanical, or visual, as long as it defines the entry point precisely and requires no subjective decisions from you.
No ambiguity allowed.
None. Douglas stresses it can even be mediocre in terms of its perceived analytical power, because the primary goal here is mental transformation, not finding the ultimate analytical edge. You simply need a consistent setup you can follow repeatedly without guesswork.
Okay, precise entry. What about exits?
You also need an absolutely exact stop-loss exit determined by market structure, like a recent low or high, not an arbitrary dollar amount. You must know precisely how much you are risking to find out if this particular trade works before you even enter.
Risk defined upfront.
Always. And maintain a consistent time frame for both entries and exits. For example, always use a 30-minute chart for signals. You can use longer time frames as filters, like only taking trades in the direction of the major daily trend, the old saying, the trend is your friend. This often allows for lower risk entries, like buying dips in established uptrends or selling rallies in downtrends. The structure provides predictability in your actions, even if the market remains unpredictable.
What about taking profits? That's always tricky.
Yes, he notes taking profits is arguably the most difficult skill to master for most traders because it often involves cutting a winning trade, which feels counterintuitive or leaves you feeling like you missed out on more.
Fear of leaving money on the table again.
Exactly. Douglas suggests a scaled-out approach as one possibility. For instance, taking 1/3 profit at a small initial target move, then immediately moving the stop-loss to the entry point for the rest of the position.
Ah, so you lock in some profit and make the rest risk-free.
Precisely. This creates what he calls a risk-free opportunity. This concept is crucial because when a portion of a winning trade covers the risk of the whole position, you immediately get to experience trading with a much more relaxed, carefree state of mind. This prevents panic on pullbacks and allows you to potentially hold for larger gains with the remaining position without the constant pressure of losing on the trade.
That makes psychological sense. What about risk-reward?
He advises aiming for at least a 3.1 risk-to-reward ratio, ideally, meaning you risk $1 for every potential $3 of profit. With this kind of ratio, a win rate of less than 50%, even down to like 30–40%, can still be consistently profitable over time. This reinforces the idea that individual trade outcomes don't matter nearly as much as the overall mathematical expectancy of your edge playing out over a series.
And this leads to the sample size idea.
Yes, this is vital. Trade in sample sizes, at least 20 trades, maybe more. Do not emotionally live or die on single trades. Expand your definition of success or failure to the outcome of the entire sample size, just like a casino operator looks at the results over thousands of bets, not just one. You know the odds are in your favor over a series of events, not necessarily on each individual one. This structure helps manage expectations and prevents emotional attachment to any single trade's random outcome.
So you need to test your system first to know those odds.
Absolutely. You also need to test your chosen variables beforehand through backtesting software or forward testing in a demo account to thoroughly understand your approximate win-to-loss ratios and average gains versus average losses. You need to know your edge's statistical properties. The ultimate objective is to think objectively, in the market's perspective, as if you were a casino operator. You're just running a numbers game based on probabilities, not trying to be a market guru predicting the future.
Okay, that's the setup. What are the strict rules during the exercise?
The rules of the exercise are simple, but incredibly powerful in their rigidity. You must commit to trading at least the next 20 occurrences of your precisely defined edge, no matter what.
20 in a row, no exceptions.
No deviation. That's the key. No extraneous factors allowed. I don't like the look of this one. The news looks bad.
Yeah.
No changing the variables midstream. No second-guessing the signals. No skipping a valid setup. No adding to winners or averaging down losers unless it's part of the predefined tested system. You execute flawlessly until the sample size is complete.
Why so rigid?
Because this duplicates exactly how a casino operates. Rigid variables, the rules of the game, fixed odds known in advance, and an unwavering commitment to taking every single bet, every event in the series, knowing that the overall probability edge will inevitably play out if the process is followed consistently. It forces you to confront your internal resistance to structure and uncertainty.
Okay, so what happens when you do this? What are the expected outcomes?
The expected outcomes are very telling. If you, by some chance, already deeply believe and function according to the 5 fundamental truths, the exercise will likely feel effortless, free of fear, resistance, or distracting thoughts. You'll just execute.
But for most people.
But for most, Douglas predicts this exercise will create a direct, unavoidable, head-on collision between their desire for objective probabilistic thinking and all their existing internal resistances, fears, bad habits, and self-sabotaging patterns. He warns readers to expect it to be virtually impossible to follow the rules perfectly at first, as your ingrained habits and conflicting beliefs fight back against the new structure.
So if you hit that head-on collision, which sounds likely, how do you handle these inevitable internal conflicts? You can't just give up.
No, you don't give up. Douglas offers a clear path. First, monitor and self-discipline. Continue to observe your thoughts, words, and actions objectively, without judgment. See the internal resistance flare up, the urge to deviate, the fear, the rationalizations. See it for what it is, just a part of your old programming arguing for its existence.
Acknowledge it. Don't fight it blindly.
Exactly. And critically, simultaneously, work to internalize the truths. Write down the 5 fundamental truths and also what he calls the 7 principles of consistency. Keep them visible where you trade.
What are those 7 principles?
They are: 1. I objectively identify my edges, meaning you know your system's verifiable criteria, free from hope or subjective interpretation. 2. I predefine the risk of every trade. You know your exact stop-loss exit before you even enter, fully accepting that potential loss up front. 3. I completely accept the risk, or, as he clarifies, you accept that you don't need to know the outcome, neutralizing the emotional charge. 4. I act on my edges without reservation or hesitation, no fear-based freezing or overthinking once a valid signal appears. Just execute. 5. I pay myself as the market makes money available to me, taking profits systematically according to your plan, without greed or fear of missing out driving decisions. 6. I continually monitor my susceptibility for making errors, constant self-awareness to catch old patterns or new mistakes creeping in. 7. And finally, I understand the absolute necessity of these principles of consistent success, and therefore I never violate them. Unwavering discipline born from understanding the psychological cost of breaking them.
Those are powerful affirmations of intent.
They are. Keep them visible, repeat them with conviction, internalizing them through conscious repetition, and most importantly, through action. When thoughts inconsistent with the truths or principles arise, this one looks risky. Maybe I should wait. I should take profits now even though it hasn't hit my target. Acknowledge them non-judgmentally. They are just parts of your psyche arguing for their old, comfortable, but ineffective version of truth. Then, consciously refocus on your objective, on the probabilistic reality, and execute your plan anyway.
So each time you followed the rule despite the internal noise.
Each time you act consistently with the truths and your rigid rules, you draw energy away from those conflicting beliefs and empower your new, desired beliefs. You are literally rewiring your mental pathways through focused, disciplined action. You're building the consistency muscle.
And how do you know when you've arrived, so to speak? When is the mechanical stage complete?
Douglas says, you will know that thinking in probabilities has become a functional, effortless part of your core identity when you can complete a full sample size of 20 or more trades without difficulty, without internal resistance, without conflicting thoughts sabotaging your actions, when executing your plan feels natural and automatic. At that point, effortless consistency becomes a natural function of your identity, not something you have to force with willpower.
You're acting from a different set of beliefs.
Exactly. Beliefs that compel consistent behavior, making it effortless, and then you'll be psychologically prepared to move into the more advanced, subjective, and intuitive stages of trading if you choose.
It's a profound journey of self-discovery, really, disguised as learning about markets. It asks you to change yourself fundamentally, not just your trading charts or indicators.
That's the essence of it. You have to transform the trader to transform the trading results.
And that wraps up our deep dive into the mind of a trader with Mark Douglas and Trading in the Zone. We've peeled back the layers of trading success today, revealing that true consistency isn't found primarily in complex charts or economic forecasts, but within the disciplined, responsible, and fear-free mind of the trader.
Hmm. It's about accepting the market's unpredictable nature, truly embracing probabilities, and fundamentally redefining your relationship with risk, loss, and winning.
It truly is. The market isn't out to get you. It's essentially a neutral mirror, reflecting what's going on inside you. Master yourself, your thoughts, your emotions, your beliefs, and you gain mastery over your market interactions.
Well said. The internal game dictates the external results.
So as you reflect on all this, consider this final thought for you, the learner. If consistent success in trading is fundamentally about transforming your mindset, not just your methods, what hidden assumptions or unresolved emotional conflicts might you be holding on to right now that are subtly sabotaging your potential?
Good question. What beliefs are running in the background?
And following from that, what's one small conscious step you can take today? Maybe starting with that self-observation Douglas recommends, to begin debugging your own mental software, allowing you to truly flow with the market instead of constantly fighting it, or yourself.